One office building cost a lender almost $891,000. Not because the property was worthless, because every day an REO had a price tag, carrying costs, tenant issues, bad pricing, delayed decisions. I'm Bruce Douglas, and I spent 20 years looking at assets from the lender's side of the desk. Today, we're cutting open the file. Welcome to REO Asset Autopsy. Commerce Center Plaza, a 28,000-square-foot multi-tenant office building in the Murphy Canyon submarket of San Diego. Built in 1987. Mixed professional tenants, a staffing company, 2 medical practices, an insurance agency. That loan-to-value of 112% means the bank is owed $450,000 more than the property is worth at current market value. Before carrying costs, before disposition fees, before the time value of money. Now, the occupancy rate of 34% is critical. This isn't an empty building. It has tenants. That sounds like a good thing. It's actually a complication. I'll explain why in a moment. The borrower on this property, a small commercial real estate LLC, stopped making payments in Q3 2024. Originally a 10-year commercial mortgage originated in 2019 at a 4.2% rate. The refinance they were counting on in 2023 didn't happen because rates had more than doubled. The lender, a regional bank, initiated loss mitigation. They tried a loan modification first. The borrower couldn't sustain even the modified payment. Then came forbearance. Then a deed in lieu of foreclosure that fell apart when title search revealed a mechanic's lien from a contractor the borrower had stiffed. 16 months after the first missed payment, the bank completed the foreclosure and the asset transferred to the REO department. That's where I come in. That's what this channel is about. What happens inside the institution after that transfer? Here's the first thing most people don't understand about commercial REO. The foreclosure is not the end of the problem. It's the beginning of a new set of problems. This is where most REO analysis stops being taught and starts being avoided. Everyone talks about the price. Nobody talks about the clock. Every single day this asset sits in REO, it costs the bank money. $385 per day. That's property taxes prorated, insurance, property preservation, utilities on the vacant portions, and the internal overhead of the asset manager assigned to this file. Property preservation, $12,400. Repairs and deferred maintenance, $88,000. The HVAC on the second floor failed during month 2. The bank had to fix it or risk losing the remaining tenants. Insurance, $9,200. Property taxes, $31,000. San Diego County doesn't care who wrote the check at foreclosure. Total annual carrying cost, $140,600. At 134 days in REO, the bank had burned through just over $51,000 in carrying costs on top of the $450,000 it was already underwater. Total loss on this asset, approximately $501,000 before disposition fees. Most people hear occupied building and think, good, there's cash flow. That's the investor's lens. From the lender's lens, partial occupancy on a REO asset is a legal and logistical nightmare. You now have tenants whose leases predated the foreclosure, and depending on your state and the lease terms, those tenants may have significant rights that complicate your ability to sell. The asset manager on this file made a mistake. They listed the property for sale before resolving the tenant situation. 2 tenants stopped paying rent the moment they heard the building was in foreclosure. That happens more than you'd think. Tenants get nervous and start holding rent. Lost rental income over 134 days from those 2 tenants, approximately $38,000. That's money that could have partially offset carrying costs. Gone, because the communication strategy failed. The asset ultimately sold to a regional medical group for $3,450,000, against an unpaid balance of $4.2 million. Total loss to the lender, Unpaid balance deficit of $750,000 plus $51,000 in carrying costs, plus approximately $38,000 in lost rent, plus disposition fees of roughly $52,000. Total realized loss: approximately $891,000 on a $4.2 million loan. That's a 21% loss on the original loan balance. Could it have been lower? Yes. 1. Tenant communication should have started the week the asset transferred to REO, not the week the listing went live. 2. The HVAC failure should have been anticipated. A proper property condition assessment at REO transfer would have flagged it. 3. The listing price should have been $3.55 million from day one to price for speed. Instead, they listed at $3.9 million and sat for 67 days before the first price reduction. Every one of those 67 days cost $385. This is what the lender's desk looks like from the inside. Every asset has this story. Every story has these numbers. And every day those numbers grow until the asset sells. The platform you saw in this video, Douglas REO Command Center, is built to track all of it in real time. Every carrying cost, every tenant status, every market data point. It's the only institutional-grade commercial REO platform on the market. I know, because I built it. Free 30-day trial. Link in the description. No credit card, no obligation. If you manage commercial REO assets, book a demo and let me walk you through it. Next week on REO Asset Autopsy, we're going to Pittsburgh, the industrial park, the surging foreclosure market, and what happens when a lender inherits a building with environmental issues nobody disclosed. Subscribe so you don't miss it. I'm Bruce Douglas. This is The Lender's Desk.